Hello friends, I am Nisar Ahmed Khan, Professor in Department of Economics, Aligarh Muslim University. I'll talk about financial system. What do we mean by a financial system? What purpose it serves? What are its components or constituents? We may consider any economy. The economy may be a developed economy, a developing economy, a poor economy, a rich economy, a large economy, or a small economy. In all type of economies, there are three economic entities or units. What are these three economic entities or units? One is balanced budget. Balanced budget units Balanced budget units are those units whose income and expenditure are same and consequently their budget is balanced. Then we have surplus budget units. Surplus budget units are those units whose income is more than their expenditure. Consequently, they have some surplus in their budget. And then we have deficit budget units. Deficit budget units, as the name itself suggests, are those units whose income is less than their expenditure. If you forget about the balanced budget units because their budget is balanced, so they are not in a position to spare any fund and they also do not require any fund. The problem is with this surplus budget unit and deficit budget unit. The surplus budget units have some surplus which they can spare, and deficit budget units are the units which require additional funds. So, who are the surplus budget units? The households are usually the surplus budget unit, but it does not mean that all households are surplus budget units. Even the firms may be surplus budget units. But usually large amount of savings come from the household, so we say usually households are the surplus budget unit. Similarly, who are the deficit budget units? The firms, the business units, they are the deficit budget units. But not necessarily all business units or firms may be deficit budget units. Even the households, some of the households may be deficit budget units. But nevertheless, usually business units or firms are deficit budget units. So what is the problem here? The problem here is that how to transfer the surplus from the surplus budget unit to the deficit budget unit, because they have surplus funds which they can spare and they need funds. So the transfer or channelizing these funds from surplus budget unit to the deficit budget units. These surplus budget units are also known as ultimate lender. Ultimate lender because there are some intermediaries who may be standing between the ultimate lender and ultimate borrower. That's why we are using the word ultimate, because otherwise lender and borrower is enough. But anyhow, they are the ultimate lender, and deficit budget units, they are the ultimate borrower. So how can you say ultimate lender or ultimate borrower? Ultimate lenders are those lenders who are not only the lender, but they are also the owner of the fund. So this fund is owned by the surplus budget units, and this deficit budget units, they are ultimate borrower because they are not only borrower, but they are also the user of the funds, that they are borrowing it to invest it and to use it. So they are the ultimate user of the funds. Now, this is this entire system we know, that is financial system, is a setup or a system which channelize the surplus from the surplus budget unit to the deficit budget units. It is a setup, it is a system which channelize the surplus from surplus budget unit to the deficit budget units. So, this is the function of the financial system, and this is what we mean by the financial system. We will talk in detail how these funds are channelized from the surplus budget unit to the deficit budget units. So, what the financial system is supposed to do, what are the functions? The first one is that financial system induce the surplus budget unit to save more and more. That is, attractive schemes are introduced, attractive rates are given, and as a result the surplus budget units are induced to save more and more. The second function is mobilization of the surplus from the surplus budget units. Now, these surplus budget units are spread all over the country, all over the economy, and their savings and their surpluses are also very small. So, the financial system mobilize their small savings, and this is called as mobilization of the saving or mobilization of the funds. That is the second function of the financial system. Then financial system channelize these surplus funds or these savings of the surplus budget unit to the deficit budget units. That is the channelization of funds from the surplus budget unit to the deficit budget units. But then there are several deficit budget units. The funds has to be allocated among these deficit budget units. So, there is another function that is also performed by the financial system, that is allocation of funds among the deficit budget units. And this allocation of fund is very important, because if suppose more funds are allocated for production of apples, there will be more production of apples, and if the less funds are allocated for a particular commodity, there will be less production of that commodity. So, how the resources are going to be utilized in the country, in the economy, that will very much depend on the allocation of funds among different deficit budget units. So, we see that the growth of the economy, at what rate the economy will grow, and what that is decided by the capital formation, and capital formation will be done by these deficit budget units, and these deficit budget unit will do capital formation, will invest it, provided they get the funds which are provided by the surplus budget units. So, how efficiently these funds are collected from the deficit budget units, how these funds are effectively these funds are mobilized, and how effectively these funds are channelized, and how effectively and efficiently these funds are allocated among the deficit budget units, it will, all these things will determine the rate of growth of the economy, that is the rate at which the economy will grow. So, that is why this is very important, this channelization. Now, we will talk about the methods, that is what are different methods through which the surplus from the surplus budget units may be channelized to the deficit budget units, because a financial system basically does this job. So, let us talk about the methods of channelizing or transferring the surplus from the surplus budget unit to the deficit budget units. So, let us write here surplus budget unit. Surplus budget units we have written here, and here we have deficit budget units. I have already told you who are the deficit budget units. These are usually business units, or these are producers. The producers may be individual like farmer, or producers may be companies, or whatever it may be, but these are all deficit budget units. Now, one method of transferring the funds from the surplus budget unit to the deficit budget unit is known as direct method. Direct method means the deficit budget units directly obtain funds from the surplus budget units. No one stand between the deficit budget unit and surplus budget units. So what actually happens? The deficit budget units issue securities. They issue securities, various types of securities. These securities like bonds, like shares, preference share or different type of stocks they issue. These deficit budget units issue securities, and these securities are purchased by the surplus budget units, and in return the surplus budget units provide the funds or cash. So, the funds from the surplus budget units move to the deficit budget unit, and the securities move from the deficit budget unit to the surplus budget units. Now, this is for every trade, for every transaction a market is needed, the market in which this transaction will actually takes place. So, there is a market here as well, and this market, this both the deficit budget unit will sell their securities and surplus budget unit will purchase. This market we call it as financial market. This market is called as financial market. So, this is financial market. In this market, the securities are being sold by the deficit budget units and purchased by the surplus budget units, and the funds are transferred from the surplus budget unit to the deficit budget unit. Funds means that when that surplus budget unit make payment for the securities, the money or the cash comes are transferred to the surplus deficit budget units. So, we have here we write cash. So, this is the direct method, and in the direct method there may be brokers who may act as a facilitator. They are not intermediaries, they are facilitator. They help the deficit budget unit to sell the securities, and they help the surplus budget unit to purchase these securities. So, they are facilitator, they are not intermediaries. Then there is an indirect method. In the indirect method, there are some middlemen who stand between the surplus budget unit and deficit budget unit. What they do? They collect funds from the surplus budget units and make these funds available to the deficit budget units. So, these middlemen, since they are operating in the financial market, we call them as financial intermediaries. We call them financial intermediaries. Financial intermediaries. These financial intermediaries are financial middlemen. They stand between the surplus budget unit and deficit budget unit. What these financial intermediaries do? That these financial intermediaries issue their securities. They issue their own securities. They issue securities. These securities may be in the form of deposits, these securities may be in the form of bonds or other type of schemes like insurance. These securities may be in the form of mutual funds. Whatever it may be, they issue the securities, and these securities are purchased by the surplus budget unit, and the surplus budget unit make payment. So, cash or funds goes to the surplus budget units. Now, what they do, these financial intermediaries, the funds that they obtain, they invest it in the primary securities issued by the surplus budget units, securities. the securities issued by the deficit budget unit, these financial intermediaries, they purchase. So when they purchase the securities issued by the deficit budget units, the fund or cash is transferred to the deficit budget units. So we see that what is actually happening, the cash is again going to the deficit budget unit, but it is going through financial intermediaries. That is, the financial intermediaries or financial middlemen are standing between the surplus budget units and deficit budget units. So consequently, we see that this method is known as indirect method. Compared to the first one, this is an indirect method. So there are two ways to transfer funds from the surplus budget unit to the deficit budget unit. The first one is a direct method, the second one is an indirect method. Now, as far as financial intermediaries are concerned, the financial intermediaries, they purchase securities from the deficit budget units and issue their own securities. That is the financial claims against themselves, and these financial claims against themselves, which we are calling as securities, these are purchased by the surplus budget unit and cash moves to the financial intermediaries, which they ultimately make available to the deficit budget units. Now, the securities issued by the deficit budget units, who are the ultimate borrower and ultimate user of the fund, and securities issued by the financial intermediaries, who are not the ultimate user, they are simply middlemen, and the funds that they are providing to the deficit budget unit are also not owned by the financial intermediaries. These funds they have obtained from the surplus budget units. So financial intermediaries are neither the ultimate owner of the fund nor they are the ultimate lender, but ultimate lender or ultimate borrower. They are middlemen operating between the ultimate lender and ultimate borrower. So the securities issued by the financial intermediaries are known as secondary securities. These are secondary securities. So secondary securities are the financial claim issued by the financial intermediaries against themselves. Whereas the securities issued by the deficit budget units, whether these securities are the securities issued to financial intermediaries, these are called as primary securities. These are primary securities. So now we can distinguish between the primary securities and secondary securities. Primary securities are those securities which are issued by the ultimate borrower, ultimate user of the fund, or the real sector, and the deficit budget units are the ultimate user of the fund, ultimate borrower. So securities issued by them are known as primary securities, whereas secondary securities are the securities which are issued by financial intermediaries as claims against themselves. So the issuer of these securities is not ultimate borrower and also not ultimate lender. So therefore, the financial secondary securities are those securities which are issued by the financial middleman. Now, the secondary securities issued by the financial intermediaries are less risky. For example, deposits. Deposits are less risky. So the surplus budget units, they happily purchase these deposits. They deposit their money with the financial intermediaries like bank, and whereas the primary securities are more risky. For example, crop loan. The bank has given a crop loan to a farmer. This farmer is the ultimate user of the fund. The farmer is a deficit budget unit, but this crop loan is quite risky. So what actually financial intermediary is doing, that they are issuing less risky securities to the surplus budget unit and purchasing more risky securities from the deficit budget units. That explain the essence and existence of the financial intermediaries. So essence and existence of the financial intermediaries lies in their ability to transform the risky securities obtained from the deficit budget units into less risky securities issued by themselves, that is financial, and made available to the surplus budget units. That is, this transformation of the primary securities which are more risky into secondary securities which are less risky is the essence of the financial intermediaries, and that explain why do financial intermediaries exist. Now, this financial market is of several types. We will talk about this. And before we talk about financial market, I would like to tell you this entire system, I have told you earlier also, this entire system, this system of system of transferring the funds from the surplus budget unit to the deficit budget unit is known as financial system. So, financial system is a setup which channelize the funds from the surplus budget unit to the deficit budget unit. And in this system, there are a number of constituents, there are a number of components of this system, and there are number of number of entities who operate in this system either as a facilitator or as a middleman. So, the constituent of the financial system are financial market, financial intermediaries, and then there are certain instruments. These instruments here are securities, and these securities which facilitate the transfer of funds from the surplus budget unit to the deficit budget unit, we call them as financial instruments. So, in the financial system we have financial market. This is one component of the financial system, financial market. This is one component. There is a second component, and this is financial instrument. Financial instruments. There is another component, and that is known as, written here, financial intermediaries. And we also have the fourth one that we will write here, and that is financial services. So, financial market, financial instrument, financial intermediaries, financial services, they all are the constituent of the financial system. If we if you have all, then they makes the financial system. So, I again define the financial system is simply a setup, a system which facilitate or channelize the funds from the surplus budget unit to the deficit budget units. The components of this are financial market, financial instruments, and financial intermediaries. So, I will talk about financial markets. What are different? There are different ways in which the financial market may be classified, divided into small groups, and we call it as components of the financial markets or classification of the financial market. So, the classification of the financial market depends on the criteria that we use to classify the financial market. One criteria of classifying the financial market is by the nature of the claims. So, we are talking about the classification of financial market. How can we classify financial market into different components? So, one criteria is by nature of claim. So, by nature of claim, what is the nature of claim? That is, there are two. Financial market can be divided into two parts. One is known as debt market, Another is known as equity market. So broadly speaking, the financial market can be classified into two markets by nature of claims, that is debt market. In the case of debt market, it is simple borrowing and lending. The funds are transferred from the surplus budget unit to the deficit budget unit. That is simple borrowing and lending, and the borrower pays interest and which the lender gets. So this is a debt market. In the case of equity market, the owner of the firm or the owner of the owner of the business sell a portion of his ownership, and when he sell a portion of the ownership, the buyer of this share become the shareholder and also become entitled to a share in the profit. So these buyer of these shares are known as shareholders. But in the case of debt market, the ownership is not shared. It is simply borrowing and lending. So that is one way of classifying the financial market. There is another way in which we can classify the financial market, and that is by the time of delivery. By the time of delivery, that is whether it is cash or futures market. In the case of cash, the payment is made in the current time by the buyer to the seller, cash payment. In the case of futures market, the agreement is signed in the present time, but actual transaction, actual payment is made in future. That's why we call it as futures market, or we can call it as forward market. There is another way in which we can also classify the financial market, and that is by maturity of funds. By maturity of the funds which are traded in the financial market. Then the financial market may be classified into money market and capital market. In the money market, the funds of less than 1 year duration are traded, and in the capital market, the funds of 1 year or more than 1 year are traded. So by maturity of claims, that is whether the claims are maturing in a period of less than 1 year, if this is so, then these are the funds, this market in which this is done is known as these are traded is known as money market, and the funds which are maturing in 1 year or more than 1 year, these are traded in capital market. And so this is another way in which the financial market may be classified, that is by the maturity of the claims, by maturity of claims. Then there is another way in which we can also classify the financial market, and that is by nature of or by the type of securities, or we can say by type of securities by type of securities, it may lead to confusion. Rather, we write here, instead of by type of securities, we simply write here this either new securities or old. That is, then this way the classification is primary market and secondary market. So, there is another method of classifying the financial market, that is, it depends that whether the securities which are traded in the market are new or these securities are old. Using this criteria, we can classify the financial market into primary market and secondary market. Primary market is the market in which brand new securities are sold. So, the securities here are issued by the deficit budget units, or securities may also be issued even by the financial intermediaries, and these are purchased by the surplus budget unit. But the important characteristics that these securities are issued for the first time. Now, secondary market is a market in which the securities which have already been issued, already been traded, already been sold are again traded, sold and purchased in the market. So, you can say that primary market, if you talk from the point of view of cars, the primary market is a market in which the brand new cars are sold, and the secondary market is the market in which the second hand cars are sold. There is another method in which we can classify, that is by institutional arrangement. Institutional arrangement, this is another criteria. Using this criteria, we can classify the financial market. And here we classify the financial market into organized market and unorganized market. Organized market is that market where rules and regulations of the regulators are observed. The regulator may be government, regulator may be any other body, the rules and regulations are observed, and, and the organized market is within the control of the regulatory authorities. Whereas in the case of unorganized market, that this is beyond the control of regulatory authorities and the rules and regulation of the regulatory bodies are not observed. We can give an example of unorganized market. The examples of the unorganized market are the participants in the unorganized markets are money lenders, indigenous bankers, landlords, friends, relatives. They are the usually they lend money in and they are part of the unorganized market. Where in the organized market we have banks, we have mutual funds, we have insurance companies, we have development funds, and we have a number of other non-banking financial intermediaries who are part of the organized market. Then there is another method we can also use to classify the financial market, and that is by arrangement, organizational arrangement. By organizational arrangement, here the financial market are again classified into two broad groups. Organizational arrangement means that how these securities are traded in the financial market. So there are exchanges. We also call them stock exchange, and then there is another one which is known as over the counter market. Over the counter market. Stock exchanges are the place where orderly buying and selling of securities take place. There is a designated time and during which buying and selling takes place, and there are people authorized who can participate in the buying and selling of securities in the stock exchange. It is not open to all, and there are securities which are listed and which are approved. Only these securities are traded, that is, all type of securities are not traded, and there is a particular place where trading takes place. There is a particular timing during which trade takes place, and there are set rules and regulations, and the trade takes place according to that. Whereas over the counter market is simply a network of dealers, brokers, and others who are connected by internet, and through internet, or they are connected by telephone or through SMS, and they carry out trading among themselves. Now they can provide customized services, and there are no timings for this trading. This trading may take place during daytime or during night time, and there is the securities traded in this market are those securities which are not listed in stock exchanges. So usually the securities of small firms are traded in the over the counter market. So these are some of the ways in which we can classify the financial market, but usual classification of the financial market is by maturity of claims. Broadly, we classify the financial market into two groups, the money market and capital market. So, but there are other ways as well which we can use to classify the financial market, but only one is enough, because the purpose here is to know the components of the financial market. So all the components, all the segments will be covered if we classify the financial market by maturity of claims. So we will go by this classification, that is by maturity of claims, and where the financial market is classified into two sub-markets, and these are money market and capital market. So we will talk about money market and capital market in our next lecture. Thank you very much.